Hello and welcome. I'm Amy Maxwell from Citywire, and I'm pleased today to be joined by fund managers Alex Ralph and David Roberts from the newly established Palomar Fixed Income, the first in-house boutique powered by Ned Group Investments. This is the second episode in a three-part series designed to introduce Palomar Fixed Income, the people behind it, and the strategies within it. A warm welcome to you both.
Thank you.
Thank you.
Now, this episode obviously focuses on the market opportunity. So, David, I'm going to start with you. Could you explain why now it's all coming together for bonds?
Yeah, well, Alex and I are of the opinion that the current level of likely return offered to bond investors is as good as we've seen for at least a decade, and there's a real opportunity to make money in the long term through consistent investment in an asset class that, in all honesty, had been overvalued for quite a number of years until the sell-off in 2022.
Is this looking like the old normal to you? And if so, can you explain what that was?
Yeah, well, again, so we look at what's happened in the market. We had a decade or so of QE, so bond markets in particular, but mostly really all financial assets were heavily manipulated by central banks. Now that they've retreated certainly to an extent and we've moved from a kind of QE to a QT world, then that creates an opportunity to for things to revert to the way they used to be. Now, you know, what we're really talking about is a 10-year plus period which was kind of abnormal. So from our perspective, we're returning back to that old normal world where bonds should be a little bit more predictable, where the majority of return should come from income, but hopefully Alex and I can then add some alpha on top of that to enhance returns for investors.
And let's just dial back a little bit and just to really understand, why did it get so out of kilter? You mentioned their quantitative easing. We had some very unorthodox monetary policy. So was there anything else in the mix there that made bond investing quite so tricky during that post-financial crisis era?
I would probably say that rather than being tricky, it was just too easy, which I know sounds a strange thing for a fund manager to say, but all we needed to do was just buy risk. We just needed to open our eyes every morning and just go and buy some more bonds because yields continued to fall, capital continued to increase in price. So it was actually a very, very easy period. And I would say that a lot of people have grown up with that and don't really understand perhaps some of the nuances and subtleties inherent in what I would describe as the old normal, the true bond environment.
Okay, now Alex, I'm going to move on to you. With risk reward now looks like it's tilted back in favour of the investor. And this is suiting kind of your more defensive style of investing. So it's been a long time. So can you remind us what the core bond investing involves?
Yeah, for us, core bond investing means highly liquid. We've both been through the 08-09 crisis, and liquidity is so important to bond investing. Global, predominantly Western markets for us. We really are seeing at this time us not having to go into those dark equity-like corners. So we're not going to be investing in AT1s or triple Cs. So we're trying to keep the bond portfolio core to be able to generate those income returns. So liquidity, Western markets are really the main drivers of our core bonds.
Can you provide maybe some examples of the type of opportunities that are opening up within those spaces?
Currently, we see valuations in credit as not particularly attractive. We look at both credit and government through three different ways. We look at technicals, valuations, and fundamentals. And for us, valuations in credit aren't particularly attractive in terms of capital gains, but they are giving us some nice income. So at the moment, we see cross-currency opportunities more than anything else. We much prefer European investment grade over US investment grade. The valuations are much more attractive within Europe. We also don't really see particular great opportunities within core high yield, but we do actually see good valuations in corporate hybrids, for example. So even though the overall market, the valuations aren't particularly attractive, there are always those opportunities to eke out better income returns. We definitely see opportunities, as I say, within Europe over the US.
And David, could you explain some of the opportunities you're seeing?
What we do within our the portfolio is to blend the credit and the rates risk. So one of the first things I do is work with Alex to understand exactly what type of credit she's looking for, and then we will use rates to ensure that the overall portfolio construction is similar to what we want it to be. So as Alex has said, she's very pro-Europe and at the moment in terms of investment grade. We're maybe slightly less comfortable with European sovereign bonds. So as a result, we would use bond futures to reduce European duration and move it into our more favoured parts of the market. And one of the advantages for us as active managers today, we're coming out of that QE period as we've mentioned, and that really creates big opportunity across markets. So different governments, different central banks are moving at different speeds, and that desynchronisation of the monetary cycle, if you like, is creating opportunities within sovereign markets, and yields are moving at radically different levels. We're at that kind of classic cyclical tipping point where people aren't too sure whether the next move is up or down in terms of bond prices. And that's true not just of the market in general, but when you look at things like the value in France versus Italy or Germany versus the US. So that does create some really good opportunity. Again, as Alex has said though, in terms of broad brushes, we're generally more exposed to the shorter end of the bond market, so less maturity, less duration in either indices or perhaps some others are running, because we just don't see interest rates coming down as quickly as many have suggested, and you're really not being paid for taking an awful lot of risk in fixed income markets.
Okay, so while the QE exit is going to be patchy, that presents an awful lot of opportunity for you guys.
Absolutely, yeah.
Fantastic. Okay, well that's it for this episode. We've heard about the market opportunity. In our third episode, we'll be hearing more about how the fund works. Thank you very much for joining me.
Thank you.
Thank you.